to this evening's or this day's webinar. Depends on when you're listening to it. I am Casey Bird, Investment Advisor Representative with Principal Preservation Services and also Principal Wealth Services. We have Mike, you all know, the co-owner of Principal Wealth Services, as well as the owner of Principal Preservation Services. The reason why we're joining you today is we want to have a special market outlook as we're past the second half of the year. Everything's just continually getting more and more intensified, and a lot of questions going around as far as what the market's doing today, what it has done, and what it potentially will do. So we have joining us today Tony Parrish, who is the Chief Investment Officer of AlphaStar Capital Management, who's going to offer his insight on the markets, what they've done, what they're doing, and what they could potentially do going forward. Thank you, Tony.
Thanks, Casey, and thanks to you, Mike, as well, for giving me the opportunity to speak to everybody today about the state of the markets. Let me go ahead and share my screen. Hopefully you can see my screen now. All right, thanks very much. Let's jump in to the state of the markets. State of the markets as of June 30th, 2021. So half of the year is behind us. By the time you see this, less than half of the year will still be ahead of us. And here's our agenda for today. We're going to look at the first half of 2021. We'll give a recap, including a summary of the conditions that we encountered. And we'll look at the investment returns across the capital markets. And then we're going to talk about what happens next in the capital markets. Will the market strength continue? What are the risks to monitor? And what are the challenges for investors? So let's get going with the first half recap. All right, summary of the first half conditions. What did we see contributing to the markets in the first half of 2021? Well, we had an ongoing reopening of the economy, bouncing back from the COVID pandemic. We saw above average economic growth. We saw a relatively effective vaccine rollout in the US, but an uneven rollout elsewhere. And of course, there is a correlation between vaccine rollout and economic reopening. We saw the pandemic threat moderating, but of course, at midway point in the year, it certainly still remains. We saw easy monetary policies from the US Federal Reserve and from central banks around the world. We saw an improving labor market. We saw a firm housing market, greater US household wealth than before the pandemic. And this is something I really want to dive into with greater detail later in the presentation. We saw an inflation debate, whether inflation is what the Fed calls transitory or not. Transitory is another word for temporary. And finally, we saw an environment with stable tax rates. All in all, these conditions were highly favorable for the capital markets. As we'll see in the subsequent slides, this created an incredible backdrop for investment returns in stocks, in bonds, and in other asset classes. So let's look at some of those returns for the first half of the year. On this slide, you can see first half of the year, this was an exceptional return for the stock market. We put on the screen a number of different segments of the stock market. And we see small cap stocks on the left-hand side with total returns of about 23% for the first half of the year, all the way down to emerging market stocks on the right-hand side with returns close to 10%. So this was an exceptionally strong return environment for stocks. In fact, this is another way to look at stocks. These are the industry sectors within the S&P 500. And as you see from this chart, all stock sectors, advanced in the first half of the year, ranging from the energy sector with a 45% total return in the first half of the year, all the way down to the normally sleepy utilities sector with modest positive returns, about 3%. So all the stock sectors advanced in the first half of the year. In the bond market, the conditions were a little more mixed, and with the exception of long-term treasuries on the right-hand side. I don't know anybody that owns long-term treasuries outright, but some people certainly do. But they're quite uncommon in the realm of bond holdings. Aside from long-term treasuries on the right, inflation concerns really caused more or less mixed returns for the bond market, ranging from modestly positive to modestly negative, as you see on this chart. And then finally, in this group, this was a strong environment for the income segments. These are the types of investments that people normally invest in to deliver income or yield. You see REITs, the real estate investment trusts, with returns of about 22% for the first half of the year, so very, very strong returns, all the way down to emerging market bonds on the right-hand side with just modestly negative total returns. In fact, if we just line up all of these asset classes that we looked at and we expand the view, so not just the first 6 months of the year, but looking at the last 12 months, that is June 30th, 2020 to June 30th, 2021, we see the returns here across the global capital markets. And once again, with the exception of long-term treasuries on the far right-hand side, we see this was an exceptionally strong 12-month period for the capital markets. I want to draw your attention to the vertical axis on the left side of this chart. That axis goes up to 70%. And we see that small cap stocks, for instance, had total returns over the last 12 months of about 68%. But of course, strong returns were not limited to just small cap stocks, mid cap stocks, growth stocks, value stocks, large caps, emerging markets. It almost didn't matter which area of the stock market you were in. You realized exceptionally strong total returns. And even in most of the income segments, you had very, very strong returns as well. So I want to reiterate, the conditions for the first half of the year were exceptionally positive for total returns across the capital markets. The last slide I want to show you in this group of slides looks at the first half. This is all the S&P 500. And we look at the first half returns for every year for the past half century and for 2021. So we go all the way back to 1970. And we see that the red bar represents first half returns for 2021. And then we have ranked first half returns for all of the other years from 1970. So we see that those 2021 returns in the red bar, they were strong enough to rank in the top quintile, or the top 20% of all of the stock returns in the first half of the year that we've seen over the last half century. So if you weren't convinced that this was a very strong environment for stocks, just look back over the last 50 years and you'll see that it certainly was, at least in the S&P 500 and really broadly across most other asset classes. So while everyone loves to know what happened in the past, and it's important to put the past in context, what more people want to know is what's going to happen next. And in this next part of the presentation, we'll talk about the market strength and ask, will it continue? We'll look at the risks to monitor, and we'll look at the challenges for investors. So remember, I showed you those first half returns for 2021 relative to all the other years. I asked myself, in the past, when the first half returns were double digits, that is 10% or above, what has historically happened in the subsequent 6 months? So when we had really strong first half returns, what happened in the second half of the same year? And as we see here, in every single instance, second half returns were positive when we had double-digit first half returns. Of course, a lot of investment analysts might just stop there. They will have cherry-picked the data, and they're showing that to us, and they want you to take it at face value. But we're not satisfied just with that. We really need to ask ourselves two more questions to get a better understanding of what we expect to happen for the rest of this year. The first question is, what were the economic conditions that created this strong environment this year, regardless of what happened in 1979 or 1996 or 1983? What were the conditions that led to strong returns this year? And do we expect those same conditions to persist throughout the second half of the year and beyond? So let's look at those conditions. This is just a recap of the first slide that I showed. And as you can see on this list, 7 out of the top economic conditions that we saw in the first half of the year, we believe with a high degree of conviction that they will persist through the second half of the year. Ongoing reopening of the economy, above average economic growth, effective vaccine rollout, easy monetary policies, improving labor market, firm housing market, and greater U.S. household wealth. With a high degree of confidence, we can say that those things will continue to have an influence in the second half of the year. The last 3 things we also believe will be favorable, but we have less conviction in those views. The first is that the pandemic threat will moderate. We do expect it to moderate, but we are less certain about that view. We said that inflation is transitory or temporary. We believe that that is the case, but we have less conviction in that view. And we said that we've been in a stable tax rate environment. We believe that will persist, but we have less conviction in that. Those are going to be three of the risks that we unpack and dive deeper into later in the presentation. Okay, what I'm going to do now is just run through a whole sequence of slides. Each one of these slides in and of itself is not particularly important, but what I want you to do is just look at the collection of slides in total so that hopefully you'll get a view of the broad environment for investing. This first slide looks at the Fed's balance sheet. Specifically, it is the Fed's holdings of mortgage-backed securities. Every month, as of right now in August 2021, every month the Fed is buying $80 billion of US Treasuries per month and $40 billion of mortgage-backed securities per month. And essentially what is happening is, as the Fed continues to buy all of these assets, it is having the effect of absorbing volatility, removing volatility from the capital markets. This has had a favorable effect on mortgage rates, a favorable effect on interest rates, keeping them low, and it also puts in place a likelihood for V-shaped market movements if the markets sell off, comparable to what we saw in 2020. This next slide looks at the 30-year fixed mortgage rate, and it looks at this data over the last 50 years. We see that it has never been cheaper for homeowners to borrow money for their homes. Once again, the Fed's heavy-handed involvement in the markets has helped to keep mortgage rates very, very low and to keep borrowing rates very low for real estate. This next slide looks at the housing prices. This is the median sales price for new houses sold in the US. I used new houses, but I could have used existing home sales. It would have shown the same trend. We've seen a firming up of housing prices, and that has been very good in terms of adding to the wealth effect of homeowners. The market implications for this are that the Fed's market activities suppress mortgage rates, and that has the effect of keeping housing prices propped up. The next slide looks at inflation. This is one of the measures of inflation, PCE, and without a doubt, we saw some wild swings in inflation. When the COVID pandemic hit and the economy went into lockdown, prices plummeted, and then Washington came in with massive stimulus, and the Fed came in with all kinds of stimulative monetary policies and caused prices to really jump up and create lots of eye-popping headlines about inflation. Since then, we've seen the inflation numbers starting to calm down, and we believe that inflation will calm down, and most of the big price swings are likely behind us. The market implications are reduction of inflation fears is bullish for both stocks and for bonds. This next slide looks at the 10-year Treasury yield. Clearly, the bond market is not concerned about inflation. This slide goes back for 5 years, but we could have brought it all the way back to the time of the financial crisis. Essentially, interest rates have remained exceptionally low since the Fed introduced QE 13 years ago. And we expect this low rate environment to continue, which also means that investors really have to look elsewhere for yield than the traditional bond markets. This slide looks at retail sales, primarily in e-commerce. So this is online commerce, ordering from Amazon, et cetera, as opposed to ordering goods from your brick and mortar local store. Prior to 2020, we saw that there had been a steady increase in the size of electronic commerce, and the at-home economy really caused that to kick into high gear, as you can see on the right portion of this chart. It really shot up. And while the economy reopens and people start going back out and relying less on the Amazon.coms of the world, that will put some downward pressure on this, but we don't expect the trend to reverse anytime soon. Another way to state that is we expect that online commerce, e-commerce, will continue to have a large and growing presence in our economy. The market implications of this are this should provide continued support for growth stocks and IT stocks and the communications sectors. Okay, this looks at the unemployment rate. We've seen large improvements in the unemployment rate in the second half of 2020, but much more moderate improvements in the unemployment rate since then. By the way, we recently had a new payrolls number, and the unemployment rate has now dropped to 5.4% as of August 2021. So that's a good improvement, but once again, that's a relatively modest improvement compared to what we had seen in the second quarter and third quarter of last year. The market implications are good, however. We see a Goldilocks environment for wage inflation, not too hot, not too cold. That means that most workers that are qualified and want jobs can get them in this environment, but it also means that wage inflation has not grown so high so as to really handicap corporate America in its payroll expenses. So Goldilocks environment also very favorable for the markets. And the last cluster of slides I want to show here have to do with U.S. household wealth. This chart shows real disposable income across the country. And as you see in the text, U.S. households have more disposable income now than they had before the pandemic. So the market implications are ongoing strength of the U.S. consumer. This chart is a variation on the previous chart. This is U.S. household net worth. Post-pandemic, the U.S. household has far more wealth than it had before the pandemic. In fact, if you look at that trend line, that solid blue line, and then you follow the dotted red line, the dotted red line shows what we would have predicted U.S. household net worth to be by the end of the first quarter 2021. And then we see that that's at about $120 trillion. However, the blue line shows what U.S. household net worth actually was at the end of Q1, and that was $130 trillion. So the actual household wealth in the U.S. is roughly $10 trillion greater than what the trend line predictions would have forecast. $10 trillion greater. To take a step back to get a sense of the magnitude, the entire U.S. economy is only about $22 or $24 trillion. So if consumers and households are $10 trillion more wealthy than what would have been predicted prior to the pandemic, we know that U.S. households are on average doing incredibly well. And once again, the market implications are ongoing strength of the U.S. consumer. Last two charts. Let's look at the balance sheet of the U.S. household on average. We have assets on the left, we have liabilities on the right in parentheses. And we see that post-pandemic, there's just been a ton of growth in household wealth. This is the year-over-year change, Q1 2020 to Q1 2021, the change in dollar terms. We see that assets grew by 25 trillion. We see that net worth grew by 25 trillion. We see that financial assets grew and corporate equities and mutual funds grew and non-financial assets grew. The growth of those assets of the U.S. household, the growth was huge. Compare that to the liabilities, which just grew at a very small level. That means the balance sheet is much healthier for U.S. households now relative to where it was in 2020. And then finally, this is a variation on the previous chart, which basically shows U.S. household growth on a percentage basis rather than on a dollar basis. And the thing that really pops out more than anything is on the left-hand side. Checkable deposits and currencies grew by 178% over the 12-month period ending first quarter 2021. That is basically cash in the bank. U.S. households are flush with cash. The thing I do want to point out, having said that though, is the third chart from the left. It's called Other Loans and Advances, which also grew at a pretty healthy pace, up nearly 50% year over year. What are other loans and advances? Well, a major component of that has to do with margin accounts at broker-dealers. So what are margin accounts? These are basically loans that broker-dealers make to investors so investors can invest more assets in usually the stock market, but it could be investing in anything they hold in their broker-dealer accounts. What this means are more and more people are borrowing money to make their investments. Needless to say, this is a dangerous trend and one thing that we need to watch. This is a risk. Higher margins means higher leverage, which means larger profits when markets are rising and larger losses when markets are falling. When the markets start falling, expect the leverage to exacerbate the problem, create a negative feedback loop, leading to more losses, which leads to more selling, which leads to more losses and causes a spike in volatility. So while we're not sounding the fire alarm about this right now, this large leverage amount in broker-dealer accounts is a concern for us and something that we're monitoring very closely. And then finally, I want to mention something that I call the gamification of investing. What we see in this line chart is the stock price of GME, which is a company called GameStop. So that's the price as indicated by the blue line. And the trade volume, the number of shares traded in that stock, is represented by those gold bars, those thin gold bars. And what we see is that GameStop was a company, a very small company, that went from $0.28 billion market cap to $21.1 billion in market cap. Why? Well, the company's business model didn't change, but simply a group of investors banded together to drive up the price of that stock. This is an example of temporary price distortions that can take place in the capital markets, especially with small companies such as GameStop. And this type of price distortion can lead to problems in the future, and it's a risk that we're certainly paying attention to, and we want investors to pay attention to as well. Okay, so let's recap the second half of this presentation. What happens next? Our base case scenario, our base forecast for what happens next are above average economic growth, easy monetary policies, a pandemic threat that continues to fade, though remains in existence and remains a threat, and a strong US consumer. The market implications for this, or the investor implications, are strong environment for the stock market, specifically growth sectors, cyclical sectors, and small and mid-cap stocks, and support for the income segments of the market, such as real estate and high-yield bonds. That's our base case scenario for the second half of the year and beyond. However, there are certain risks that we need to be aware of. One is a resurgence of the coronavirus and its variants, the Delta variant, for instance. I mean, just look at the Olympic Games, which were played out in front of no fans, as an example of how we may have to change our activities and our expectations based on how this virus evolves. That is a concern, and if the virus really spikes, it can certainly lead to a change in our forecast, and it could turn us from bullish to bearish in our forecast. On the other end of the spectrum, one of the risks is that the economy may continue to overheat. Easy monetary policies and accommodative fiscal policies may create an environment where inflation gets ugly, causing the Fed to have to slam on the brakes and possibly sending us into recession. I don't expect that to take place in the second half of the year. Inflation tends to be more of a slow-moving trend, but it is something that we have to be aware of and something we're paying attention to and monitoring very closely. And then finally, there's the prospect of higher taxes. That could come in the form of US tax rates, and it can also come in the form of a global minimum tax for corporations. I should say that I'm seeing increasingly unlikely that in the second half of this year, there's going to be any major change to tax policy. I just don't think Democrats have a strong enough, they don't have the votes to push through anything that is radical, anything that's significant. And I think this is a topic that'll get kicked to 2022 and possibly 2023 and possibly 2024 and beyond. So I'm not overly concerned about hikes in US tax rates in the near future. But the global minimum tax for corporations is something that seems to be gaining speed around the world, and that's something that certainly could pop up and create headwinds for corporate earnings globally. So final thoughts, I believe that we are in a Goldilocks period right now in the capital markets. Investors should take advantage of the calm to prepare for the storm. The storm will come sooner or later, so make sure your portfolios are well positioned so as to be able to ride out whatever storm comes over the horizon. Ensure that portfolios have the appropriate risk levels. A downturn is inevitable, but the timing of that downturn is unknown. So understand how a downturn will affect your investments, and don't overextend yourself to chase returns. Don't be one of those over-levered investors that has huge margin accounts that will cause pain when the markets turn downward. And what are the challenges now? Well, in many cases, the challenges in the second half of 2021 are the same as the challenges that investors faced prior to the pandemic. And that is how to find investments that allow you to participate in the markets while mitigating losses in the event of a downturn. And Casey and Mike can both talk to you about some of the strategies that we have available to us to participate and buffer against losses. And the second challenge is where to find yield in the capital markets. And again, Casey and Mike can point you to all kinds of different strategies that will be set up in such a way so as to generate yield on par with what the bond markets are offering, or potentially even higher yields than what the bond markets are offering. So that concludes our presentation. These are some important disclosures that our compliance department wants you to see. And with that, I want to thank you for taking the time today. And I want to hand it back to Casey and Mike for some closing remarks. Thanks very much for allowing me to present to you the state of the markets for June 30th, 2021. Bye-bye.
Tony, thank you for all that good information here. State of the markets, where the markets are at, where they're going. And for folks who are in the market with us and working with Principal Wealth Services, if there's any questions, concerns you have based off the information that was given from Tony, please contact us. We can have a meeting in the office or by Zoom. Everybody knows the ordeal, and we just want to make sure that you're happy where you're at, you understand where you're at, and if there's any changes need to be made, we want to make those changes here for you for the second half of the year. Thanks for listening.